Don't forget to press that record button. I know we've been a little bit hectic today. Yeah.
I did remember, and you may begin.
Good evening, everybody. Welcome to the Investing Roundtable for June 2025. I'll be your host this evening. My name is Ken Kavula. I'm with the Mid-Michigan chapter, and I'm joined by another one of my directors from the Mid-Michigan chapter, Mr. Mark Robertson. Many of you know Mark from Manifest Investing. Mark is a great addition to our board of directors, and he's been a great help to us in keeping programs going. You're looking at a program that is well into its 15th year of operation now and still going strong. Tonight, we've gone all the way south. We have 3 Southerners with us tonight, 2 of them from the big state of Texas. Matt's a former cohort of mine on one of my investing clubs, but he and his lovely wife decided to take their son and move to Houston after he retired. I think that's where his wife is from. And he and Ann Menning are both directors on the Houston chapter, and they've been guests before here at the roundtable, and we're so happy to have both of them. They're wonderful presenters, and they have a great sense of humor, and we're glad to play with them in our sandbox here. And our other Southerner is from Atlanta. He's a regular night of the roundtable, Mr. Cy Lynch. As soon as he speaks, you'll hear that Southern accent going on along with Ann's. Matt doesn't have a Southern accent, but Ann and Cy have enough for all 5 of us, so we're all set to go. All right. Welcome, Ann, Matt, and Cy. Matt, Mark, welcome to the roundtable, and let's get started, okay?
All right. And
glad to be here.
For those of you wondering, San Antonio is on our bucket list to visit and maybe teach a class down there, and we just thought we would get there by way of Houston. Apparently, they're suburbs of each other or something like that.
It's only three hours to get there.
The Texas Triangle.
All right, we'll get underway, but I do want to point out that I look pretty chiseled in that blue night outfit.
Good stuff. Picked the nicest one for yourself on this one, Mark.
I did, but I think
he made you king.
Yeah,
but my head's not on my body the right way, is it? I don't know. Yeah. Maybe not. Okay.
Well, sometimes it's tough out there in the battlefield. So let's go ahead.
This is an educational demonstration, everybody. We're not making any recommendations to buy, sell, and hold. Every stock we talk about, including the stocks that we preview tonight, are for illustration purposes only. We might hold some of these stocks in our own personal portfolios or in portfolios of clubs that we belong to. And if we do, we'll try to notify you, but don't hold us to that because sometimes we forget. If you'd like a copy of the slides, send a note to Mark R. at manifestinvesting.com or send me a note at kcavula1@comcast.net. We'll get you the list of slides, the whole deck of slides for you to take a look at your leisure. We do post all of these sessions on our Manifest Investing, Better Investing, Roundtable, YouTube channel, so you can go to the YouTube channel as well and see these. This will be posted here tomorrow morning. But for the moment, let's go to the next slide and see what it says. Okay, Mark?
Well, Ken, I just wanted to point out that over on the left, the lower left, you know what that is?
Coconuts.
It's a lovely bunch of coconuts.
All right.
All right. Ann is actually the president of the Houston chapter. And I thought, Ann, you might want to describe some of the activities in your area.
Really? You want me to start on that, huh?
Yeah, absolutely. Yeah. Plus, I want you to explain that bull. Bull looks a little bit.
Well, that came along before that I was president, so I'm not sure. Maybe Jennifer, our communication person, came up with the bull, but I'm not really sure about that one. We do cover a huge area, not as big as probably as mid-Michigan, but in Texas, it's a pretty big area. So we have some regular classes that we have teaching people just money basics. We have a 3-week class. It's like 4 hours each Saturday, teaching people how to invest with the SSG and the research you need to do that. We're very involved with our club visits. Matt has done a great job getting that back on track. And so any of you that are in the Houston area would like to join us, we'd love to have you.
Thank you, Andy. You guys do have a model club that I would encourage
Yes.
anybody who would like to get their feet wet to explore.
We have a lot of square miles, Ann, but a lot of it is just pine trees. So,
Yeah, I don't even think people in our own chapter realize how big our chapter is. It's quite large.
Oh, it's got to be huge.
Here's the performance of the roundtable. Most recently, we compare ourselves to the Wilshire 5000, which over the entire 15 plus years of the meeting of these knights and damsels has performed at 13.5% annually, and that's an excellent performance for the Wilshire 5000. But the roundtables performed at 16%. That means that we're beating the market by 2.5 points, and it's not as good as we did for a number of years previously to all the volatility that's been going on, but it still places us in the upper echelons when we compare ourselves to a lot of the mutual funds and ETFs that exist. Mark tells me after doing an analysis that we're still probably in the top 10% of all mutual funds and ETFs that exist as far as performance is returned when you compare it to a benchmark like the Wilshire 5000. Our outperformance accuracy has moved up a little bit, and I'm happy to see that.
Well, I have a footnote on that one. I found an error in our calculation. So we had been down in the lower 40s, but that is an audited number. So
Well, great. We're almost exactly at 50%, and we're aiming to outperform at 55%. That means just for each one of for 55 out of every 100 stocks that we choose, we'd like for them to make money. And we've done a lot of research, and those three sites might seem a little bit strange to be put together. Rex Tillinghast is an author, and he's done a lot of writing about how you don't have to win 80 or 90% of the time in order to be extremely successful. 55% seems to be a number that if you can hit that on a regular basis, then you have a chance to really outperform. That Federer is indeed Roger Federer that you see in the citation there in the left-hand side of your screen at the bottom paragraph. And Roger Federer won an outstanding number of his matches. But as far as games were concerned within those matches, his percentage of winning games was just about exactly 55%. And Peter Lynch wrote a number of different times about how if you could score with 55% of the stocks that you chose, that you probably would be a very successful investor. So that number has some gravitas attached to it. And I'm very happy that we're at 50 right now and moving in the right direction. I'd like to see this other graph turn around a little bit. And I guess
it's stabilizing. It's stabilizing.
I guess to make that happen, Mark, we're going to have to do a little bit of work in looking at what's in this immense portfolio and maybe do some cutting and pruning and weeding to get this to kind of turn around and move in the other direction. That might be the job that you and I are going to have to do between roundtable sessions once or twice.
Yeah, well, the stocks are being relatively uncooperative right now, and that will end at some point.
I hope so. But like I said, 2.5 is still a wonderful, folks. If your investment club or your personal investments can outperform by even a single %, You are doing outstanding as far as comparing yourself to what the professionals do and comparing yourself to what most other investors do. So when we can say 2.5% over this long a period of time, I think that we can be quite proud of the record we've put together. What's our next slide look like, Mark?
Well, it looks a little better than it did. This is the top 20 holdings in the roundtable tracking portfolio. Now, we keep track of every single idea submitted to the roundtable, whether it's from a knight or a damsel or the audience vote. And the legend on the upper right tells you how many times a particular stock has been selected. Check out this number, Ken. This was just 110.
I know I'm seeing
my-
123, and I'm that's a great number because I could remember we were down at 108, 109, 110 just a little bit ago. Yeah.
Microsoft has been chosen 5 times, so there's $5,000 invested in it. That's our basis, if you will, and that is now $123,000. So you can look down the list. There's a couple of single-time selections on here, Costco being one of them. There might be one other one there, but anyhow, that legend allows you to decode. If you want to look at the entire list of holdings, this is a public link. We won't even know you're there. You can look at the entire dashboard and get a look at that entire list of approximately 80 companies. We have actually had an increase in par and an increase in growth rate for the portfolio, a gentle one, but we want to continue driving both of those numbers up over time. And most recently,
especially that sales growth rate, we'd like to push it a little bit higher if we could, right?
if we can, we want to do that without getting too crazy. But down on the lower right are the 5 companies with the lowest return forecast. That doesn't say they're bad companies. In fact, that Fabrinet that you see at the top, I think that's up 64% annualized since Ken picked it. How long ago would that have been, Ken?
Oh, maybe a little bit more than a year, year and a quarter, year and a half, something like that. Yeah.
The reason its par is so low is because the stock price has just rocketed since Ken chose it. So he's kind of riding that wave. The one that we'll talk about for a couple of minutes is Five Below. That has a relatively low return forecast or par, and then the others are just kind of on the edge, perhaps in threat of extinction. We'll see.
I think what's so interesting, Mark, is that we hardly ever pick a stock that has a quality rating lower than, say, 70 or 75. And we're looking at Clearfield and Dollar General with quality ranks that have moved down towards 50 or even lower. And that means that there's been some real degradation in some part of their business model to cause this decline in quality. It's either a degradation in the balance sheet, or it might have something to do with profitability or the way it competes with people in its own industry. But those two we probably should take a serious look at and kind of wonder the growth that goes with those two at sub 5% might make them great candidates to move out of the portfolio as well.
I think all of us concur. Any comments from our participants tonight? Are you guys ready to move on?
No, nothing really to disagree with. That's for sure.
Yeah, and I only toss this out. I don't follow. I've not updated my Five Below thoughts. With the recent couple of months in, but just be a little wary on Five Below of selling. I mean, Five Below was suffering before we got into tariff mania,
right?
But I just don't like selling into manias that may, and I'm referring to tariff mania. I'm not referring, because the other problems Five Below was more company oriented with shoplifting and some of the other pricing issues they were dealing with. So but I've not updated my thoughts on Five Below. Though I will be, because I'm about ready to look at it for my Better Investing article. But that's the only comment that I have on that.
I basically put together this slide to kind of take a look, a visual look at what's been going on. There's a couple things here. It is at a relatively low projected return compared to its historical numbers. I mean, the sales are still pretty strong. The quality has degraded a little bit for whatever reason. They have been struggling a bit. This is the one that I would point to, and this is just a value line opinion, but that 3 to 5 year price forecast has been heading south for quite some time. So that points to some of those other problems, non-tariff related, that you were talking about. And we talked about this afternoon at bull sessions. Their cash flow actually did turn negative in 2024, and that's going to put pressure on the company. And their margins are slipping, and the PE that would be required to produce this number here is actually this elevated number, which is above the value line forecast. So it's a company that's first of all, we love it. This goes all the way back to the legacy of Nick Strategos here at the roundtable. So we're practically naming children or grandchildren after the company, so we feel pretty strongly about it. But they clearly have hit a few operational challenges for sure. Any thoughts
Marta,
on this, Ken?
explain the significance of the red box on top of the blue box in the PE ratios there. What are you trying to demonstrate there?
Basically looking at the trend, first of all. So you see the history of the company has operated, and then it's, in the 30 range, but it's been slipping. The PE has been slipping along with the quality. Notice that the two kind of go together. The blue box here, this is the value line forecast for the 3 to 5 year forecast, mid-teens. In order to achieve this par of, what's the par on here? Okay, well this is our par. The value line par projected annual return is actually negative. And even to achieve that, in order to achieve our par, you need that red incremental bar on top. So you need a PE in the mid-20s.
So it has to
get
go
there.
9 or 10 PE points above where it is right now to make that happen in PE expansion then, right?
Yep.
From where value line thinks it's going to be. Okay.
And we've been talking a lot about cash flow. The cash flow has definitely flattened.
Yeah, I don't want to beat this horse to death because we have a lot to do tonight, but I know that the company had been suffering from shrinkage. Did any of you notice the article where Walmart has suddenly decided to do away with self-checkout?
Yes.
And I think that they were experiencing a lot of the same issues that Five Below was, that there were many studies done about self-checkout, and they found that self-checkout made it too easy for folks to become dishonest. And folks could rationalize why they were becoming dishonest. And the biggest reason that folks were giving was, well, if you're going to ask me to do work to buy something from your store, I'm going to get paid for it. And the way they got paid for it was to pilfer something from the list of things they were putting in their bags and everything. So, but when Walmart does something like that, I think a lot of retailers are going to follow right after them and do the same thing. So they just abruptly decided to close their self-checkout lanes. That's good for employment, but it's not real good for the technologically driven ways that they were trying to increase profits. So,
yep. So
I went into a Lowe's store yesterday, and they have gone totally to self-checkout, which I was shocked.
Yeah.
Well, that's not going to be for very long, and if this article is correct, that is circulating around. Yeah.
Yeah. I think Home Depot is following them too, Ann, because that's been my experience at Lowe's, which sometimes for various reasons was annoying to me. But last time I went to Home Depot, they also had all the registers closed except for self-service. So.
Interesting challenges ahead, and we'll see.
Yeah.
So anyhow, I think it's probably enough reason to exit the position, but tough sledding ahead for this company for sure.
The only thing that I'm going to say, Mark, is the same advice that you've given me a couple times in the past 6 or 8 months, is that we remind ourselves that Mr. Nicholson warned us to be very careful about exiting positions where they had double-digit sales. And Five Below is growing at double digits. It's growing at more than 10%. So
And
could we
Yeah,
go on?
this
I
trend
was
is pretty
just
solid. Go ahead.
yeah,
Sam.
and I was just going to say, of course, I don't see you. You've got the operating margin time, and you had the quality by time on here. I just looked at the current Manifest Eagle, and I am guessing the quality decline that you are seeing corresponds to that margin decline, because of the three of the four components of quality, that being sales growth, profitability, financial strength, and earnings predictability, the only one that is below average for Five Below currently is margin, and it's fairly significantly below industry average. So I'm suspecting the quality degradation has been in that profit margin, which to some extent goes with the shrinkage and some of the issues they've been dealing with.
All right.
As well as regular inflation and trying to keep your prices below $5, which of course they're working on that also. So.
I think we've given this a fair shake, Mark, and I'll support your moving it out of the portfolio, and we'll kind of watch and see what happens. This is an experiment. It's been an ongoing experiment for all these years, and we're still learning from it. So let's move it out, and then maybe make a vow to do a little bit of work in the next month to look at some of the slower growers also.
Yep.
Again, not bad stocks necessarily, but real slow growth. Yeah.
So if we do this, I'm going to need for everybody in the audience to raise your hands and tell me that you're not going to jump all over me when this company recovers 18 months from now.
That will not happen, and you know it, Mark. Okay.
I've said enough for the recording, so I can say I told you so. But just to wrap that up, I don't oppose moving it out either, and because of the low par, at least since Value Line has decided it hates Five Below and maybe is a bit overly pessimistic.
Yep.
My primary comment is we may obviously we don't have others of that low a par because it's the second lowest par in the portfolio, but there are other stocks in this rather large portfolio that we probably should be looking at moving out as well.
Absolutely, and that can't be done at a round table. It needs to be done and brought to the round table. So we'll work on that in the next month. We'll take a vow right here. I do have a hand in the air, and Ben, I'm going to unmute you, but we're going to kind of keep it short. I'm trying to keep us sort of on schedule here. So Ben, I can't unmute you because you're muted on your end. You'll have to unmute yourself. And the hand went down, so that's probably an inadvertent hand. And let's continue then, Mark, okay?
All right, so I'm going to go for last word, and I'm going to invite the audience. We've been doing a lot of work with cash flow. This afternoon, we talked about this is a very nasty situation for many companies to go negative in cash flow. This one is understandable. They get a break from COVID. When this happened, there was a well-defined reason for it. And in fact, it was a reason that Cy bought the company back then. But to go negative, stay tuned. Join us as we take a closer look at that. So I'm going to go ahead with the program, Ken, if you're ready.
I'm ready, Mark. Let's do it.
All right. I'm going to go ahead and go first tonight because I turned in my homework before everybody else this month. So, all right. So again, going out looking for companies to possibly study or nominate. I wanted to look for triple play qualifiers who also might qualify for Hugh McManus's Irish Spring, and that would be a stock price close to their 52-week low. So went out, basically said, okay, show me the ones that are potential triple play candidates. We ended up with this list of 6. I did want to limit the growth too because Ken is obsessing with double-digit growth. We have that here, and then Hugh McManus really loves for a company to be trading at least 20% within its 52-week low, and there's a couple here that are there, but this is not incredibly sexy, so I'm not terribly interested in that either. Nothing is jumping off the page here. Corpay maybe a little bit, but nothing is really grabbing. So I want to talk about cash flow. This company, Comfort Systems USA, was presented by Candace Baker in April at the round table, and Comfort Systems is one of a relatively small set of companies that has increased its cash flow each of the last 10 years. We call it a cash flow aristocrat. I want to find those. In the absence of a small, exciting startup company that we can bring, this would be the hunt for a core company. And you can see the numbers right here. The cash flow basically increasing year after year. For those of you wondering if this is an increase here, it is. It's 4 cents from here to here. Okay, so we want to find more of those. You go out and look at these companies, you will find 10 years of increasing cash flow as you look down that company, or as you look down this list of companies. Here's Comfort, but you see a whole bunch of community favorites here, from Brown and Brown to most of the companies. T-Mobile surprised me a little bit, but Microsoft, our dear Microsoft, is right there. Tractor Supply, again, a pretty decent list of companies. They are sorted from top to bottom. I did feature NAIC at the recent Better Investing National Convention, and that's where it came from, a list just like this one. Tonight, I'm going to go with Netflix. Even though this number is a little bit low, this number is a little bit high, I just think it's an incredibly strong company that will probably be here 10 years from now and perhaps generating some decent returns. The company's on the A list, and you can get to that list using that link up at the top. It's a public link. Just make sure you have an A here, not a B or a C. I want you to fix your attention on that number. That's a pretty strong number for companies that have this strong cash flow characteristic. Here are some of the leading companies with respect to their return forecasts in the B list. The only difference between the A list and the B list also has 10 years, but they have slower growth rates. And still great companies. Jerry Wright from St. Louis presented Accenture during the April roundtable. It's right there. In the C list, basically are companies that are very close to having that 10-year track record, but they have one oops, maybe one speed bump. And during tonight's presentation, you're going to hear about Pulte, Deckers. Ken was going to do T. Rowe Price, but he chickened out. Plus, he just likes disagreeing with me. So he decided not to go with T. Rowe Price. But you can see this is a pretty good list of companies from top to bottom. Again, you can reach all of them using those public links, but there's some pretty good shopping right here. Look at those return forecasts. All right, so the company's Netflix. I don't think I have to explain the company to the audience. Almost everybody has a Netflix account. It's cost effective, and it's basically a lot of fun. Good entertainment, very strong sales track record that you can see there. You see the 10 years of increasing cash flow. This is an up, straight, and parallel like crazy. The stock price is it's had its hiccups, it's had its speed bumps, but boy, it's performed very well over time. Again, very, very solid cash flow, very solid profitability. The PE ratio has behaved pretty well. It's been historically high, a little bit like the paycheck of days of yours. And cash flow growth in general is pretty strong at 12.4. So good stuff. So this is the company we're looking at. It's not off the charts with respect to the return forecast, but it is relatively close to multi-year highs. The one exception, this period back here was a great time to buy. And then I'm also correcting an omission from the recent past. A couple of years ago, Kevin Gologly said that he was going to feature Netflix right about there. So I'm merely correcting an omission or error made by Kevin from a couple of years ago and getting it into the roundtable. Again, we're talking about a company with a 10 to 12% return forecast. Again, not incredibly sexy, but decent growth, very consistent. Again, up, straight, and parallel, very solid earnings growth, which merits a little bit higher PE. The reconciliation with projected return on value versus par is here, and pretty good company top to bottom. So I'm going to suggest that we put the first $1,000, and of course the audience will vote for it, and we'll put a second $1,000 in tonight.
All right. Thanks, Mark. We appreciate that. Anne, we're glad to hear you presenting Deckers, so go ahead.
Okay, good evening, everyone. I have to say that this was probably the least amount of time I've spent trying to find a stock to do roundtable. It turned out to be fairly easy this time. I first went to the Sweet Spot, and I found Deckers brand, and it was the only one that had 100 quality. So I thought, well, you know, let's look at that one. And for those of you who attended the virtual bank, you heard Robin Ware from the North Florida chapter present this at the Let's Talk Stock session. And then I looked in the roundtable, and we had not had this in the roundtable, so I decided to go with it. Next slide. Y'all all know I like to give you a little bit of information from the background. So this company was started by two students while they were attending University of California in Santa Barbara, Doug Otto and Carl Lopker. I'm not exactly sure how they did this while they were in school, but they did. Carl would go out to craft fairs or flea markets and sell their sandals on the weekends. And they started this in 1973. So Doug went to Hawaii and found out that the locals called their sandals Decas. And that's how they got started being called Deckers. Otto did buy out Lopker in 1982, so they'd been in business less than 10 years. And Otto stayed with the company until 2008. Excuse me. Next slide. Deckers has a history of finding good shoes that they go out and pursue and buy out from whoever started it. Uggs is a very popular shoe. It was started by a surfer because in Australia, Brian Smith, who wanted a pair of shoes when he got out of the water from surfing would keep his feet warm. Now, I would have always thought these were something for skiers, but this is actually how they started. And it is, as you can see, is a classic boot with a sheepskin upper and a wool lining. And Deckers purchased the UGG brand from Smith in 1995. Next slide. The next company that they went out and pursued to buy was Hoka, and this is a athletic tennis shoe that was founded in 2009 in France. And Decker acquired it in 2013. These shoes are known for their oversized midsoles, and they are dubbed the maximalist shoes. These are used by a variety of professional runners and running competitions. Next slide, please. The next one that they were interested in is Teva. This was invented by geophysicist, which I thought was really interesting, Mark Thatcher in 1984. He liked to do river activities and decided that sneakers were too heavy when they got wet, and flip-flops didn't stay on your feet in the water. So he added just one simple nylon strap to a thong-style sandal, thus creating the first sports sandals. He set up actually an agreement with Deckers to manufacture the sandals for him in 1985, but in 2002 they acquired all the patents for Teva and the other assets from Mark Thatcher. Next slide. Deckers acquired a new in 2009, and they kept this in their line until 2018, and when they discontinued it. Then they decided to get their designers from the UGG and the Hoka line to redesign the new sneaker, and they relaunched it in 2024. And you can see this is a pretty nice sneaker. I will say these are more expensive shoes than maybe you might want to pay for, but a lot of people do buy these shoes. Next slide. As I said, Doug Otto stayed with the company until 2008. Stefano Carati, I'm not sure I'm pronouncing that correctly, is now their president. He became president last August. He has been in management in the retail business for a very long, over 32 years. And he used to work for Puma, which is another shoe company. Next slide. This is their latest fiscal financial review. You can see their net sales increased 16.3%, and their net sales increased 16.5%. The UGG brand increased 13.1%. The Hoka is 23.6%, and the other one is 8.6%. I'm not going to go through the rest of it, but you can look back on this if you want to. Next slide. I put this slide in because the company has seems to have a policy of buying back a lot of their shares, and they actually just approved $2.25 billion to repurchase stock. And as you can see on the SSG, the blue line is where they repurchase, and you can see that obviously this is part of their business plan to do this. They are quite consistent in this. Next slide. And you all know that this is my favorite thing to find. This is a triple play. We have double-digit gains on the left side, either from 160 to 240, with either 11% to 23% gain. We have PE expansion, and their net profit margin is rising. And I wish I had not covered up the cash flow line with my triple play deal, because you would see that their cash flow has increased over the years, and it continues to grow. Next slide. This is the commentary from Value Line, and they will tell you, which you're going to see in just a minute, they've had a run up in their price. And last September, they had a 6-for-1 stock split, and some people were not happy with the outlook for the coming year, and so profits were taken. And then, of course, we have the tariff woes have wreaked havoc on this stock. Their quotation is down 50% since January, but they raised their target to 4.9 billion. And if you see over to the right, they just released their revenue for the fourth quarter. It did increase 16% to the 4.99 billion, and their shares were increased 30%. They were projecting 590, and it was 633. And at the bottom, you will see that they're saying that they're neutrally ranked at the moment, but they're looking at this as through long-term lens, which we as better investing investors do. Next slide. Now, this is a slide you're not going to like. As you can see, the 50-day line has gone down below the 200-day line, and this where this crosses is called the death cross. And if you will look at the graph, you will see that this started in February, and this started when the tariff announcements were made. I think this is tremendously oversold. They have great fundamentals, and personally think this is a great time to look at this stock. I wish I had looked at it when it was down to like $93, but unfortunately I didn't. But I do think this is an oversold situation, and I would not be afraid to looking at this, because I think once the tariff stuff settles out, that this stock will start going back up again. Next slide. Now, on a happier note, you will notice that all of their financial ratios are great. I gave you a year ago in March, and then a few months ago, their numbers. If you look across, they are all better than you are hoping for. The only one that actually went down a little bit, which was not much, was number 3, the free cash flow. But all the rest of them are in the parameters that we want. Morningstar's fair value for this stock is 120. And I think the closing price today was a little bit below 101, but it was right around this same amount. So I think this slide makes up for the death cross slide that we just saw. Next slide. This is, of course, Manifest equity analysis, and you can see their quality is number 100. I particularly like that their par and their approved value are basically the same thing. They're very close. Manifest is projecting 13.2% growth with an EPS forecast of 11.64 and projected average price of 216. So at 101.69, we would definitely double our money in 5 years. Next slide. Okay, this is the front of my SSG. I'm giving you the numbers that Value Line and Member Sentiment came up with. And I actually ended going with the same numbers of Member Sentiment. Manifest sales forecast was a little bit higher than I was willing to go. So I felt that mine was reasonable. You will notice in 2016 and 17, I did take those as outliers. Since they were, 8 to 9 years ago, I didn't feel like this had anything to do with the company now. And so I felt like that was reasonable to take those out. And as you can see, the company is up straight and parallel. The only issue is their price has dropped. Next slide. Okay, this one's a little busy, but you can see from evaluating their management, their pre-tax profit on sales has continued to go up, and their average is 20.7. They have a great return on the equity, and they have very little debt. I decided to show the valuation ratios. That's something we don't usually see on our presentations, but I wanted you to just, this is something maybe as a whole, BI investors maybe should look at more. These are the acceptable ranges in the little boxes, and you can see to the left that Decker Brands does qualify for all of these acceptable ranges, except for the relative value is a little bit lower than I would care for. Their current ratio and their quick ratios are great. And since you want an interest coverage or 7 or higher, I think they got that one covered. Next slide. This is section 3 of the SSG. As you can see, this current price was on 620 at 101.69, and Morningstar has a fair value of 120. I did take out 2016 and 2018 because they were really high or really low compared to what they have had in the past. The ratios are down. The 5-year average is 21 and the current ratio is 16, and that certainly had an impact on what I decided to going forward. Next slide. Okay, these are my estimates. I did do the lower high PE, and even with that, I would come out with doubling my money in 5 years. I do pick the 80% as my low price, and I do come out in the buy zone. As you can see, it's 101 would be about in, close to the middle of the buy zone. The member sentiment, our price was $244.50, so obviously higher than mine. Manifest average price is $216.12, so I'm a little bit below their average price. But as y'all all know, I'm conservative in my estimates, so I'm still pleased with what I came up with. So yes, the last slide. These are my final deals. Mine is anywhere from 11 to 16, whereas member sentiment is 19.3 and manifest is 16.4. So I think this is a reasonable buy. I know this is a little scary right now for this company because of the tariffs, but we are long-term investors, and I think once the tariff stuff works itself out, this company will come back and they will, their price will come back and they will do great. So I'm presenting Decker Brands for my stock tonight, and I hope you liked it also.
Thank you, Ann. Mr. Kavula, are you geared up and ready to go?
Can you hear me, Mark?
Ken, was worried.
Yes, can you hear me?
Was worried. It's a little stormy up where you are, so thought maybe you would.
Mark, can you hear me okay?
I can hear you. You can't hear us?
Great. I can hear you too. I couldn't
Okay.
before. We're having internet issues here. Okay.
Okay.
I'm going to do a repeat, folks. IES Holdings. The ticker is IESC. Next slide, please. I presented this last month because I thought it was a candidate to really make some gains, and it had a lot of momentum going for it. And I don't usually look for momentum, but when the company is growing very quickly, a lot of times you can ride that train for a little bit of time and make some really decent cash. IES Holdings deals with all things electrical, and they are in 4 major divisions: communications, residential, infrastructure, and commercial and industrial. You can see by the colored dots on the map where they're doing the different parts of the company. They do an awful lot of business in Texas and Florida, as you can see, but they do have a pretty good coverage of the entire country with at least one of their divisions. Next slide, please.
Looks like
Medium-sized company, by the way.
looks like a lot of business there around San Antonio, Ken.
We'll have to visit, I know, okay. About half their business is in residential electronics. If it has to do with anything electrical, and that's from wiring a house to putting up electrical systems to dealing with internet problems, all kinds of things. That's the kind of work they do in the residential area, and that's about half their business. About a quarter of their business is in communications, and we'll talk about that in a bit. About half a quarter or an eighth in infrastructure, and the other eighth in commercial and industrial. So pretty evenly split among the different divisions as far as business is concerned, half residential and half the rest of the company. Next slide, please. The communications segment, which again is about an eighth of the company, is growing at a compounded growth rate of about 19%. And you can see by the dark blue states, that's where most of their communication segment work is done. This is one of the faster growing segments of the business. And basically they've discovered that doing big jobs, especially in things like data centers and distribution centers for retailers, that they can make an awful lot of money, and there's an awful lot of business to be had. So you see some of the prime real estate for data center growth, Virginia being one of the most unlikely centers, but its proximity to Washington gives it a place where data centers are being built at just a breakneck speed, but they're all over the country with this particular part of the business. Next slide. I just wanted to show you, you might think that all they do is wire a data center, but they touch a data center in all different kinds of ways. Everywhere that you see a little line going into the picture is where IES might touch for the business. So they put an awful lot of product into a typical data center. The things you would expect, lighting and circuitry, but a lot of things you might not expect, like security and audiovisual materials and things like that. IES is a complete provider, and they give it all to the data center that they're contracted to help build. Next slide. They do the same thing in an e-commerce distribution or in high-tech manufacturing. And again, anything you see that's yellow would be places that they might touch the building. And again, it's a lot more than just electrical systems. Next slide. The business overview for the residential segment, remember that's about half of their business, is growing at breakneck speed, about 35%. And even though the single family housing section of the residential business has been growing more slowly than you might expect, IES does a lot of business in multifamily situations. So they do everything from duplexes all the way up to high-rise apartment buildings, and you can see that 35% compounded annual growth rate going on, and they're doing it mostly on the two sides in the south and the east of the country right there, again with a dependence in Texas and in Florida. Next slide. Their infrastructure solutions, they provide the overview on the slide can tell you the kinds of things that use these particular services. And again, growth rate that's just fantastic at 21%, a lot of it in the Midwest and the Mississippi, Georgia, South Carolina area. Next slide. Here's some of the products that they do for infrastructure. And again, you can read these at your leisure and just write an email to Mark asking him for the slides. These are all coming from a very, very comprehensive investor presentation that IES has on their website. Next slide, please. And then the final segment is the commercial and industrial segment. That's about a quarter of their business. The revenues are not growing consistently in this particular section, but the representative markets, that list has been growing, and they've added one or two things to that list every year for the past 4 years. And again, you can see some of the things in the business overview that they're providing in this commercial and industrial segment. Next slide. Since the pandemic, and you do see the pandemic year, they're a construction firm, industrial company, and they had some problems getting people to work during the pandemic. But since the pandemic, they've come roaring back. Sales have stayed very consistent during that time, and you can see the increasing slope of that blue line and the pre-tax profit line as well. And you can see the increasing slope of price to correspond with that earnings line. I've used future sales growth of 15 and 16%, and these numbers place me on the conservative side of my source material. Next slide. That's a current price as of yesterday of $281.39. IESC closed today at $291. I wish all of you would have bought this stock when I presented it last month when it was trading at $244.57. You didn't pick my stock for the extra $1,000, and I don't feel bitter about that, but I really do think that it had quite a push up since the May roundtable. We're looking from 244 to 291. That's a pretty good increase for any stock in a 1 month period. Next slide, please. I'm choosing PE values of 23 and 15. for the high and the low forward-looking averages. And if you add those together, that gives you 38. You divide by 2, and that gives you somewhere around 19. And that's the average PE. Manifest has an average PE call of about 22, and we now have a value line for this company, and my 19 is well within the value line call for future PE as well. Next slide. I told you on that last slide that I'm anticipating PE expansion. This was very close to a buy using last night's close. The extra $10 from today will put it a little bit further outside of the buy zone. But I think the par with my SSG will still be somewhere around 10.5, 11%. I did look at Manifest right before we opened up the roundtable tonight. Manifest par after tonight's close is at 14.8%. It was 14.9% last month, and that's before Manifest redid the data, before the data was updated. So all in all, I think I'm doing a fairly conservative SSG on a company that's on a roll right now, and it's doing business in an area where tariffs are going to have hardly any impact at all, and it's doing business in an extremely high growth area in its 4 different divisions. I like the future for this company, and I'm going to suggest we add another $1,000 to IESC. I learned my lesson, folks, on Costco. We chose it once and then forgot about it for 5 or 6 years. I don't want to make that same mistake with IESC.
Okay, are you done showing off yet?
I am.
All right. Let's go to Matt, and he's featuring a company that made our best small company selections a year or so ago very happy. Thank you, Ty Hughes.
Yeah, very much so. Not a stranger to the community, but not exactly a household name either. Napco Security Technologies, ticker NSSC. So go ahead, next slide. Yep. Mark gets a gold star this cycle because not only did he get his slides done, he also invited us guest nights last Thursday, which gave us plenty of time, a lot more time than we usually do, to look for a stock. And usually that's not a problem for me. I think the best way to maintain selling discipline is to have a stock I want to buy. And particularly since I'm retired, so I don't have extra income coming in to always add on new stocks. If I want to get something new, I need to sell something. And so I always want to have something. And given, well, some earlier things that worked out or were settled out, and then the volatility, all the things I looked at in April suddenly went back up. So I just went fishing. And this is one of the tools that you have in the online BI tool set. If you see what's highlighted in green on the left, the magnifying glass, there's a custom screening tool. There's a number of predefined screens, and there's this, the Better Investing Ticker Heat Map, which is the top 100 tickers in terms of studies done, so other members completing SSGs in the last 90 days. And so the bigger the square, it's not in relative to company size, it's relative to the number of SSGs completed. And don't jump to the conclusion that red means sell and green means buy. Those are relatively the same. There's a spread where green is, let's say, better or more optimistic, but those do not label or project the conclusions of the SSG. But what I like to look for here is the smaller boxes in this top 100. So a lot of activity, a lot of interest, but not too found or too household names, and particularly a ticker that either I don't know or I don't remember. And so in the industrials, it's kind of in the upper right there, and NSSC is a nice green box, a nice solid green, kind of in the middle there. And so it was one of several I took a quick look at, and then I proceeded to get my information up to date on it. Next slide. So Napco, in a nutshell, has 3 lines of business. So they deal with alarms and connectivity, so security more generally. locking, so physical locking of doors, and then access control. So let's say permissions of different employees or different people to enter different areas of a building. They are largely in the commercial space. You can see in the pie chart below that, but they do have some residential lines. They do have an odd fiscal year. They just completed their Q3 of fiscal 2025 in May, so they're almost done with 2025. And they have some metrics there. They traditionally have sold the pieces for they use distributors or integrators who actually install them or sell them to construction companies making new buildings or doing refurbishment. But starting earlier this decade, they started to move toward a recurring revenue model, a subscription model. They are at now almost half of their revenue is now recurring, and that recurring revenue it doesn't this gross margin versus EBITDA or adjusted EBITDA, but that actually it'll be on a future slide. That recurring revenue is service revenue as opposed to hardware, much higher gross margins. I will say they're headquartered in the U.S. They do have some manufacturing in the U.S. The bulk of their manufacturing is done in a single location in the Dominican Republic, and for tariff purposes, they are not on that big list. They're kind of minimal point there, so the company feels well hedged or well diversified, both with U.S. manufacturing if it came to it, and also the Dominican Republic at this point is not a target on anyone's list. Next slide. So this is kind of a picture of what they do. If you have an office building or an apartment building or even a school, these are all the sort of things you might get from Napco. Whether it's, again, alarms, PA systems, door control systems. On the bottom left, you can see too, because they are connected now and largely wireless for all their new products, you no longer need keys, whether that's physical keys or key cards. Just like other things you expect, you can turn your car on and off with your phone. You can enter the building and do other things with the phone. Now that's not just good for residents. That's also good for the managers of those facilities to let them be more connected to what's going on in the building, and then even if it should happen, because it's a significant business line, to emergency first responders. Next slide. Oh, one other point. Sorry, just to get the animation. So you see a Starlink up there, and that is not Elon Musk's Starlink. It's kind of an interesting little sideline. Napco Starlink started in February 2017. The other Starlink started in October 2017. I see no back and forth between them. Any accusations of confusion? They both deal in wireless communication. But this Starlink has a few months on Elon. So looking at the competitive landscape, certainly Napco is a relatively small company, just under 200 million in 2024 revenue, and there's some very big players on this other side. Most interesting is Honeywell. So Honeywell is going through in the next year, will be splitting into 3 different companies. Unlike Johnson Controls, which used to own Carrier and now sort of has 2 positions on this chart, this will be one Honeywell still, going back to Honeywell's old days, looking at controls, building controls, that sort of thing, and separating from aerospace and materials. Napco makes a big deal that they are the only ones that do all 3 of these. It'd be interesting to see, maybe it's a potential kicker if a Honeywell freed of other distractions might go looking to fill those gaps, given how integrated those building systems are, as illustrated in the last slide. So they might be strong competition. They might also come calling for Napco. Who knows? Next slide. This is a little bit older slide. It's from November of 2022, so Q1 of fiscal 2023. They didn't update it this year, but they did reaffirm all these numbers last year at this time. So Q4 2024. I included this version because the growth calculations are not in the future ones, but this is an idea. We'll see look further on that there's not a lot of coverage of this company. So when you're making projections, you're kind of on your own. The company does not give annual guidance, certainly hasn't given it in its earnings calls, but they do have a long-term or target goal. This is expressly said that it's within 5 years, but some of these are actually relatively attained. So for example, in the percent of total recurring revenue, 50%, they're essentially 39% at this point. Their recurring revenue gross margin was actually higher than target even in 2023, has remained high, is now 90%, and so on and so forth. But you can see in the bottom, and I'll just give a hint, the projected net profit margin from Manifest for the company in the 5-year forecast is 18%, relatively close to the adjusted EBITDA margin, and of course it has all the extra things on it. But you can see the margin growth as they go to that recurring subscription model that they expected and are seeing today, and continuing to go. Next slide. So when first thing you're doing when you're looking at some of these companies is to look at those trusted sources, and I have to say they kind of Manifest aside to kind of strike out. Napco is on the extended edition of Value Line, so they're already only forecasting 2 years. And remember, we just finished Q3 of 2025, and this is the June edition, a fresh new edition in here with 1 quarter to go in 2025, and you get an NA. So come on, man. Like, it's 15 months of forecast, put something out there. Now, Morningstar is actually a little bit worse, if you can believe it. Give me another click. So this is a quantitative rating from Morningstar. There's not an analyst covering it. This is an algorithm who's looking at their financial statements and coming up with something. And I know that the esteemed members of this audience don't need to be reminded like Morningstar does that $27.59 is actually below $27.64, and far below the fair value of $35.39. So probably isn't really a 3-star company. Maybe it's a 5-star company. Now, when you encounter some of these things, I'm sure a lot of people just say, that's too complicated, that's too messy. I actually find this very interesting as a engineer by training and an IT person by career. I see this anomalous data, and I think that those people who are primarily relying on Value Line or primarily relying on Morningstar, maybe even screening for 5-star stocks, are no longer my competition to buy this company. So if I can figure out if these anomalies are truly a matter of the data sources and not a problem in this company, there's quite a bit of opportunity. That has paid off for me several times. Most recently, when I brought Interactive Brokers to the roundtable last summer. So is this one of those? It might be, but certainly it's at least kind of a funny story. So Manifest, of course, does cover Napco. It was in the best small companies. It doesn't look like it's a great quality. Let's just put that on there and get through the first part. Doesn't look like a thrilling par. And I hinted a little bit about where we go with that, but I'll talk about that more.
It is in this week's update batch, Matt, and
okay.
With these expanding margins and basically the trajectory of the company, this par is actually closer to 10 or 11% today.
Oh, wonderful. Well, maybe I'll skip a slide. So I'm not out of resources. I am a Seeking Alpha premium subscriber. I got that half price for me for Christmas to try out for a year. And they do have some analyst coverage. Now, this is, again, only 2 years. And notice that the June 2027 year actually only has 1 analyst. But it's something. So I'll work with it, and we'll show it on the SSG in the analyst forecasts. Next slide. Here is section 1 of the SSG. Again, I've put on the analyst forecast bubbles. The first 3 dots are those Seeking Alpha items, and then the dots for 2029, because that's the last year we can put in, is the Manifest forecast. Certainly we have good lines for this company. It's not a scorching grower, but it has good leverage and earnings per share on a 10% historical sales growth. There is a little bit of cyclicality. We can see it's been trading in not in a narrow range, but a fairly consistent range from 2023, been kind of stuck in the range, even though it's quite volatile. And we see that it's coming down in fiscal 2025 from what was a peak above trend in 2024. That has an explanation. wireless companies were retiring their 3G or third generation wireless systems, and so there was a replacement cycle that was telegraphed 2 years ago, and that's why prices went up, and executed last year and coming back down to trend. When I look at this though, and I'm being very, very cautious because there isn't a lot of backup, if you will, in going for the forecast, I just want to take another mention to manifest. If you actually look at what I'm forecasting for sales, I'm quite a bit below the manifest growth line. So the company's target was 300 million. I'm saying down to 254, manifest at 305, right in line with the company's long-term target. But then on the earnings per share, manifest is actually a little bit below mine. So if you're higher in revenue and lower in earnings per share, what is the name for that? Well, that's your margin. So as Mark talked about, that there's a big difference, at least as was presented yesterday, in margin expectations here. But we know that this company is purposefully growing the percent of its business that's at a 90% margin rate, that recurring subscription business. So its margins should improve quite a bit, which is what I have baked into my earnings per share forecast with the preferred procedure. And it sounds like manifest is coming to my opinion. That's great. Let's go to the next click. So I'm going to show section 2 and 3 here together. If you want to see how good this business is, again, this is a business of selling things, just coming into selling services with a nearly a 30% pre-tax profit on sales 2024, 29% return on capital. It's in the high teens for both, with almost no leverage. So the debt to capital peaked, if you call it a peak, at 12.4% in 2020, where things sort of got cooking, down to 3%. They actually have $28 million in debt. They hold $97 million in cash. So on a net basis, they have no debt, no problem. They're quite conservative with their financials. We look down below at section 3 at the PE ratios, and I expanded that to 10 years because certainly you see some nosebleed levels, and I've crossed out not all of them maybe, but quite a few of them. But you can see in the early years, you see highs in the 20s even, or 30s, and lows in the teens, which have been pretty consistent. I want you, if you're thinking I'm guessing too high in the future and I should be looking back in time, take a look at their margins in those early years, right? Where pre-tax profit on sales was single digits, return on equity was 10% or low teens, right? This company definitely kicked it up, and so I think that the 5-year numbers are closer, even though I'm going to still shave those down because I'm kind of sticking my neck out for this company. Next slide. So looking at section 4, I've taken a high PE of 37. Again, some might be uncomfortable with that, but look what it's been in the last 5 years. I take a low PE of 15. That's been pretty consistent. Also, remember I said this is traded in a pretty, although it's a wide range, a range since 2023. So my low price of 18.3 is in line with what's 5B number C, the recent market lows from 23, 24, and 25. So I'm quite comfortable with that. It is on the lower end of its range, but still far above its 52-week high. It wasn't in April, but I'm just looking at it now. So I do get it in a 4-to-1 upside downside ratio. A buy. I did want to mention, I forgot on the last slide, they did just also start a dividend. Again, this is a management that has kept cash close to the vest. They've just recently not only started a dividend, but also a modest buyback program as their stock has come down and they have much more cash than they need to invest. So I would look for that to continue for both of those to improve the returns as well. Next slide for section 5. So I do indeed get a compound annual return of 19%, and ta-da, or maybe we can add the manifest one, a par with the average PE of about 11%. Yeah, so I think it's a pretty fair bet in an industry Peter Lynch would like. What building wouldn't go up or wouldn't be refurbished without security or access control?
Or electrical systems.
And electrical systems.
Hey,
did they vote for 2? This is the kind of boring business, but everybody needs it, and it's going through some significant technological changes. if you look at the management presentation, they'll talk about a migration not just from 3G to 5G, but actually from wired systems to wireless systems. There are reasons behind it. I'll leave it to you to look at, but there's a lot of potential, not just into new build space and maintaining spare parts, but a lot of refurbishment of commercial buildings. That's Napco.
Thank you, Matt. Takes us to, and wouldn't you know, it's now a Georgia company. You probably would never even look at it before. Now that it's a Georgia company, Cy's going to present Pulte.
Oh my goodness, Mark, how did you guess? I tell you. I figured that we would look for a new stock because y'all would accuse me of getting stubborn or hung up on repeating the same thing, and I have not seen that Pulte is getting into information management or outsourcing at all, IT. So I figured I would do something different, but definitely with a Georgia company. Also, I'm glad that you saved me for last because you've heard some good companies to consider, and I thought I would bring it all together. The Napco was a little tough, but Pulte, Napco has some commercial, some residential business, and of course Pulte has some commercial office space and the like. So I think Napco can provide some security and locking for both the houses and the building. But I wanted to give Ken some houses to put his electronics in. And everybody needs a house to kick their Decker shoes off as they lounge to watch the Netflix movies. So Pulte kind of brings everything together.
Cy, I want to interrupt. Our audience is right on top of this. There's a typo on the slide, and one of our audience has reminded us that the Pulte ticker is PHM. It's just a typo, but
Yep.
Our audience is always sharp enough to catch things like that.
All right, and I will take down who picked that up because there are two more mistakes in here, and if you get all three, we have a prize for you. But no, thank you for picking that up, and you can see the history for a consumer cyclical company, a pretty up straight and parallel. You could see Value Line's got a pretty wide range of long-term forecasts and a pretty decent 18-month projection. So let's dig a little deeper into PHM for Pulte Homes. I just did a screen, fairly standard, just a little below the sweet spot at 14%, a little below the 5 over my par, an excellent quality, excellent financial strength, and decent earning stability. And I didn't want to do United Therapeutics again, so we left it out, and a couple others on here, and I looked at, but decided Pulte was the highest potential return on this list that I liked. So I said, let's dig a little deeper and do a industry study. Next slide. Here's the residential construction, which is an out of favor industry right now. We all know that there is a shortage of housing units, which that should bode well, but we also know that for various reasons right now, the affordability quotient for housing is relatively high, and a lot of people cannot afford to buy new homes, and so that's pushed the construction business down. You could see ranked by quality, Pulte's the highest. You've got D.R. Horton and NVR that are also excellent quality companies, and you see some others that are good quality. The next potential return candidate I've mentioned with Lennar, but Pulte has higher net margins, higher growth, and financial strength. So all of those I thought made Pulte pretty clear choice in its industry. Next slide. Pulte's the third largest home builder, and you could see the geographic representation. Again, one thing that used to be true before the 2008 Great Recession, but that real estate tended to be very regional, and you would have, up markets in some parts of the country when there's down markets, and they'd be able to offset each other. And of course, 2008 was one of the first times ever that you had a universal downturn in residential real estate. But still, even today, geographic diversification is important. Next slide.
Ken, San Antonio is on this slide too.
Great.
Along with Houston, so you can see how you can go right through Houston to get to San Antonio.
Absolutely.
And Pulte also is well diversified by sorts of buyers. First-time home buyers, you see their brands at the bottom. That's the white part of the bar chart, Syntex and Pulte Homes. Then the move up home, Pulte also builds that. America West and John Whelan, which John Whelan was founded in Atlanta. So there's even more good Georgia connection for this business. And then Del Webb and Devosta. I'm not familiar with Devosta. Del Webb, I am. That's their active adult communities. And you see they're pretty well diversified there. Next slide. And then here they show their diversification by price point. I put this slide in just because it gives you a little bit of an idea, again, how diversified the company is. I'm not exactly sure what you get out of this by precise percentages because of the fact that, as I mentioned, real estate is still largely regional. Same thing with prices. I mean, $300,000 could get you, a reasonable starter home in the outskirts of Atlanta. $300,000 isn't going to get you anything. Maybe a bathroom in California. So, this I take with a little less or a little more of a grain of salt than the other slides, but it still does show that they sell it at multiple price points. Next slide. Here is the company's description of its operating model, and they're still looking to expand into new markets. And Mark mentioned earlier the cash flow of the company, and I'll mention it briefly as well, but they're focusing on maintaining positive cash flows to build, and you could see some of their other strategies. Next slide. This slide I mainly wanted to show that one of their strategies is to move from owning the lots that they plan to build on when they start a development to holding their lots by options. So they look for developable, trying to make a slightly different word. Anyway, land that's available for development and that they find favorable, but rather than buying to own all of it, buying it through options and then going through the approvals and starting to build out the phases. Their goal is to shift into 70% options versus owned. And you can see how they're moving greater options. And in the last quarter one of 25, they were at 51%. So they're moving that way. And that just frees up more capital. It They don't have to have as much invested to actually own the land as to own an option. And then they're expecting community count growth. So to increase the number of communities for sale by 3 to 5% in 2025. Kind of keep that in the back of your mind as well when we get to my projections. Next slide. Speaking of which, here we are. I'm choosing a very low sales growth rate. If you go back to that first slide and you think about it, and it shows the Morningstar consensus, I came up with that 2.5%, just based on the projections for the next 3 years that are shown on there. It ends up being roughly in line for the 3 to 5 year value line projection, which is really somewhat on a conservative to, I would say, overly conservative point for 3 to 5 years. I think Value Line's overdoing it, and they're lower than many other projections. But I think it's solid because we just don't know when that affordability quotient is going to change. And the primary thing that can change quickly is the interest rates. When will interest rates start coming down, long-term interest rates? And that 2.5% compares to a very consistent historical rate of 12.4% for Pulte. So now, granted, some of that 12.4% includes acquisition that's probably not going to repeat. But I just kind of want to, understand where I get that 2.5%, and I am intending that to be pessimistically low, but I think when you work through, you'll still see it's an attractive consideration, even with that low sales growth. Then just keeping profit margins and taxes the same. Tax rates are very steady, and really more, pretty much so, is also true of the profit margins for Pulte. Company is pretty aggressively buying back stock, and so that's reflected in the projection of a decline in shares leads to 17.6 EPS 5 years out. Again, from the current price, that's just 3.8%. Historical is 33. I mean, excuse me. Yes, 33% is the historical growth rate, and the projected growth rate, according to Morningstar consensus, I think is a little high, but it again is in line with history. And if we believe that the rates right now are somewhat depressed, are looking at 30%. And if the company keeps pouring cash into buying back stock. So again, I think that 17 is quite attainable. Next slide. And then here's getting to the bottom line. Using a high PE of 11 gives a potential rate of return of 13%. This seems to be the month of lower pars. I think everybody is a little below the 5, the MyPar plus 5, but have found significant attraction to the companies and potential higher returns over the projections. And quite honestly, 13%, which matches some of the predecessor companies we've seen tonight, is a solid rate of return in this market, even if it's not quite 5 MyPar plus 5, it's in the MyPar plus 4 or so range. Manifest projected average return is 18.2%, with significantly higher growth, which is not an unreasonable growth projection at all, as well as a much higher PE. So I'm going to say let's take a look at Pulte and all of the other presentations and watch our movies with our shoes kicked off in a company that looks like it's a once in 5 years, certainly 3-year projection or a potential. As Mark has just shown me with flipping to my last slide, you can see that it was 3 to 5 years ago, or 3 years ago, that the par was this high, and you can see both the quality increased along with the price, and looks like the depressed price and questions about interest rates and so forth have pushed the current expectations down, but the high quality management will adjust, and when the market turns, they'll be ready to make lots of money for their shareholders, and we'll see the prices go up.
Thank you, Cy.
We're now going to run a poll. We have 5 companies that we presented this evening. They're presented for your consideration. We're asking you to vote for one of these 5 to add an extra $1,000 to the roundtable portfolio. While you're voting, I want to announce to you all that we're going to be experimenting with the start time for the roundtable going forward. And next month's roundtable, the July roundtable, which will be held on the last Tuesday of the month on July 29th, that roundtable will be starting at 7 p.m. We're going to be sure to include that information when we send out our mailing to our guest list, but I wanted you to be able to put that onto your calendar so you could adjust the start time for it. That's 7 p.m. Eastern Daylight Time. That means 6 p.m. Central. We're adjusting the times because we've had a lot of ins and outs from some of you asking to start a little bit earlier so we could end a little bit earlier. We'll see what happens with the audience. Remember that if this makes it harder for you to come live, we always have the presentations posted on YouTube. Meanwhile, I'd love to get up to 80 or 85% of your voting. We have about 70% of you voting right now. So if you haven't taken the opportunity to vote, please tell us which one of these stocks you'd like to place into the portfolio. I'm going to count backwards. There we go. Let's get a few more votes in. We're close to 80 now, folks, close to 80% voting. Let's get just a few more votes if we possibly can. There, we just hit 80% voting. I'm going to count to 10 backwards in my head, then I'm going to close the poll, and I'll release the results to you. Let's push it up 1 or 2 more points if we can, folks. It's easy. It doesn't cost you anything. And let's close that poll. And let's share the results. And they really liked your Decker's proposal, and we're going to take a gander and take a leap and choose Decker's for the extra $1,000. Looks like IES Holdings and Napco were running neck and neck in second place. Mark, you didn't come in last, okay?
All right. I would like to request that we do let's check the zip codes on the registrants here tonight and see if we had overrepresentation from Texas.
You want me to count the ballots by hand or something? Or
I don't think it would help.
Okay. So congratulations, Ann. That's a great addition to the roundtable portfolio, and I've added Decker's to my list in my personal investment club for our group to take a look at as well.
All right,
Thank you very much. I'm very surprised.
Here's our fun with artificial intelligence, and I just want to say that Super Grok apparently agrees with Ann. In fact, it leans completely Texas also, so it figures.
Is Grok Texas based too? Don't mess with Texas.
Don't mess with Texas, that's for sure. So yeah, just having a little bit of fun, saying which one seems to have the best return potential. And sure enough, they've got some great footwear in the depressed stock price. All right.
Well, our audiences are usually pretty bright, Mark, when it comes to picking a stock. They just missed out on IES last month, that's all.
All
Again,
right.
folks, we're announcing a 7 start for the July roundtable, and we're reminding you that all of our presentations, all 15 plus years, are on our YouTube channel, along with the bull sessions that we run on Tuesday at 2 o'clock. Every Tuesday at 2 o'clock, you can come to a bull session, and we'll talk about almost anything regarding investing at those bull sessions. Also, all of the Mid-Michigan educational presentations are on this YouTube channel from the last maybe 8 or 10 years. So if you're looking for a particular educational presentation, especially those that have been aimed recently at beginners for the last 2 or 3 years, please go to the YouTube channel and take a look at what we've been doing. We're getting really good feedback on some of that education. Our next bull session is this coming Tuesday. We want to remind everybody that the Heart of Illinois Breakfast Club meets at 9 a.m. Eastern time on Wednesday morning. That means they're getting up at 8 o'clock to go to that session, folks.
Yeah.
So
Yeah,
if you're
but
looking for a breakfast club, there it is, 9 o'clock in the morning tomorrow. And again, the new start time for the July roundtable at 7 p.m. And then join Cy and Mark at the Georgia Investors Fair. What's the date of that fair again, Cy or Mark?
August, just 1 second. I'll give it to, it's the day before I go on vacation, so I should know, but I don't. It's the third Friday. Just hold on. I'm trying to get it for you.
And Ken, I just
The
want to.
23rd. I'm sorry, it's the fourth Friday, the 23rd.
So the program's actually on the 24th, Si?
No, the Friday is the 22nd and Saturday is the 23rd.
Saturday is the 23rd.
Yes.
Okay.
Right. My vacation's on the 24th.
And that's clearly the date that's got your attention. So August 23rd, is that what I heard?
Correct. Yes, August the 23rd
Preserved.
is the event.
Preserved. And I just wanted to mention that Ann, you probably are. First of all, the Heart of Illinois guys will not sleep tonight, Ken, because of the shoe presentation, and probably need to towel them off. They're probably in a frenzy down there, and they will be poring over your Decker's presentation very carefully.
Well, I want to thank Ann. I want to thank Matt. I want to thank Cy, and a special thanks to Mark for all he does for the Mid-Michigan chapters. And I'm going to call a meeting of the roundtable again in 1 month at 7 o'clock Eastern time on the last Tuesday in July. See you all then.
I'll bring the coconuts.
All right. Thanks, everybody. Good night.